Imagine a bustling city that's not just the heartbeat of global trade, but also the launchpad for the financial world's bold leap into a digital tomorrow. Welcome to Hong Kong, where Standard Chartered is betting big on fintech innovation. This isn't just about keeping up with trends, it's about reshaping how we handle money in an era dominated by blockchain and beyond. But here's where it gets controversial. Could this tech revolution widen the gap between tech-savvy giants and those left scrambling to catch up? Let's dive deeper and see what makes Hong Kong the star of Standard Chartered's digital strategy, as shared by CEO Bill Winters himself. In a recent chat right in the heart of Hong Kong, Winters painted a vivid picture of the city's role as the epicenter of Standard Chartered's digital finance dreams. The bank is eyeing bigger profits and gearing up for a future where blockchain, think of it as a secure, decentralized digital ledger that records transactions transparently and immutably, like a shared notebook that everyone can see but no one can erase, redefines the game. To put it simply for beginners, blockchain eliminates the need for intermediaries in many financial processes, potentially making things faster, cheaper, and more trustworthy. Winters was effusive about Hong Kong's forward-thinking regulatory setup, which actively encourages testing out cutting-edge ideas. He pointed out how this environment nurtures safe experimentation with blockchain, a technology that could inject real value into banking by streamlining operations and opening doors to new services. For example, imagine loan processing that happens in minutes instead of days, or automated payments that reduce errors, all powered by this digital framework. A big shout-out went to the Hong Kong Monetary Authority, HKMA, the city's financial watchdog, for rolling out pilot programs and regulatory sandboxes. These are like protected playgrounds where innovators can try risky new things without breaking the rules of the real world. Winters highlighted success stories such as experiments with tokenized deposits, basically turning traditional bank deposits into digital tokens that can be traded or used in smart contracts, and trials involving wholesale central bank digital currencies, CBDCs, which are digital versions of money issued by governments. Plus, there are stablecoins, cryptocurrencies pegged to stable assets like the US dollar, ensuring they're not as volatile as Bitcoin. These initiatives help market players adopt blockchain securely and efficiently, paving the way for broader adoption. And this is the part most people miss. Just last week, the HKMA unveiled a comprehensive 5-year fintech strategy designed to erect a robust financial tokenization ecosystem. Tokenization, for those new to the term, involves converting real-world assets, like stocks, bonds, or even real estate, into digital tokens on a blockchain, making them easier to trade, divide, and manage. This strategy isn't isolated, it's part of a larger push to future-proof Hong Kong with AI and other technologies, ensuring the city remains a global leader in finance. As a key player among Hong Kong's note-issuing banks, Standard Chartered has jumped into these HKMA sandboxes, testing blockchain in controlled settings to see what works and what doesn't. Winters acknowledged that while blockchain could slash costs and fees, think lower transaction charges for customers, it might squeeze margins for banks like his. Yet, the CEO emphasized unwavering commitment: we're going to remain ahead on digital technology, and what we lose in margin, we're going to make up in volume by providing a better service to our customers. In other words, sacrificing some short-term profits for long-term growth through superior, innovative offerings. Now, stirring up some debate, is Winters' optimism justified, or could this blockchain push lead to unintended consequences, like job losses in traditional banking roles as AI and automation take over? Some critics argue that prioritizing tech might overlook the human side of finance, potentially alienating customers who prefer personal touch over digital efficiency. What do you think? Does the promise of blockchain outweigh the risks, or is Hong Kong's fintech frenzy setting a precedent that could disrupt global finance for better or worse? Share your thoughts in the comments. Do you agree with Standard Chartered's strategy, or see it as a gamble that's bound to shake things up?